Hey guys, it's Carter. Welcome back to the channel. Hope you guys are all having a great and amazing day today. Now in today's video, we are diving in and looking at the best investment strategy for 2023. Through all the ups and downs and all the volatility we've seen this year, I'm going to be breaking down my investment strategy, my thought process, and everything you pretty much must know about investing in 2023. So I hope you guys all enjoy it. If you have any questions, let me know down in the comments. And guys, if you get anything in value out of this video, hit that like button, subscribe, because it really helps me out when you guys do that. So now that's dive into this one. All right, so before we talk about my investment strategy, first we have to talk about all things stocks. What are stocks? How to buy stocks? Different account types. So what is a stock? This is actually a very common question I get asked in public is, Carter, I want to invest, but what is a stock? Well, a stock represents a small ownership inside of a company. So if you guys go out and you buy Coca-Cola stock, you represent a very small ownership inside that company. So as the company grows and becomes more valuable, that share price will rise as well, and you guys will get money off that. Not to mention, when a company makes so much money, they will pay you for being an investor. This is something called a dividend, and the beauty of dividends is you don't have to actively work for it. It's 100% passive income, so it's money coming in every quarter, and you don't have to ever work for it or even think about it. Now, some of the issues with investing in stocks is if you invest in Coca-Cola and the company, starts losing money, losing revenue, and starts closing down stores or whatever it may be, that share price will start to fall down and you guys will lose money. Another thing you guys will hear me talk about in today's video is something called an ETF. This is an exchange traded fund. Now, an ETF is pretty much just a pool of different companies. Imagine if you guys had a pie and each slice was a different company. Now, instead of investing into, all these stocks, which could add up to thousands of dollars, you guys could just buy that whole pie. So maybe you own, a very small percentage of Apple and Facebook and Tesla and just different companies. It's just a pool of different companies pulled together, that's more affordable. Now, how do you guys invest? How do you guys buy and sell different stocks? Well, you guys are gonna need something called a stock broker. So this is pretty much how we have access to the New York Stock Exchange and the stock market. Pretty much these brokers, I'm sure you guys have heard of Robinhood or Thinkorswim or Fidelity or Vanguard. These are stock brokers. So those brokers have access to the exchange. So when you want to buy a share of Apple, Vanguard will send that order to the exchange and they will purchase those shares and send them to your stockbroker. That's pretty much it. It's all pretty much instantaneous and it's all online. Back in the day, you'd have to call up your stockbroker and say, hey, I want 10 shares of Apple. And they would actually have to, call the exchange themselves or have to send an order that way. Now everything is all done online, which is very convenient because one, it cuts down on commission. It's very rare to see a broker that actually charges commission. Most brokers nowadays are all commission free, which is great for investors because you don't need thousands of dollars to invest. Now, some of the brokers I would highly recommend for beginners that are just getting started with investing is M1 Finance, TD Ameritrade, and Robinhood. All of these three are fantastic. They're very beginner friendly and they're not overwhelmingly hard. The last thing I would want to see you guys do is open up a broker and not even know how to navigate through it. But all of these brokers make it very easy to understand what's going on. Nothing's too overwhelming. Yes, TD Ameritrade is a little bit more on the advanced side, so make sure you guys take that into consideration before signing up. Now, when you guys sign up, I'm sure you're going to be very overwhelmed by the process, but trust me, it's not too hard. Pretty much how you sign up is just go on and you sign up, right? And you'll notice there's several different account types. Now, the type of account you have could be determined on your investment future, on your goals. If you're somebody that is looking to retire with this investment, maybe you guys will need an IRA account, which is just a tax incentivized account that is designed for retirement. Or if you guys are looking to use this and be in and out of positions and maybe liquidate your stuff here and there and send money to your bank and stuff like that, maybe I'll just recommend just a standard broker's account. Both are fantastic for starting out, but if you're looking to retire with this, look at some sort of Roth IRA or traditional IRA. But if you're looking to, maybe use this as some income down the road, then I would go to more of a standard broker's account, which is great. So we did talk about dividends for like a brief second, but I wanted to jump in and really give you guys some tips and tricks, because if you guys start investing into different companies and ETFs, they will start paying you dividends. So the biggest thing was signing up for a broker, that offers something called DRIP, which is dividend reinvesting. This is crucial for beginners starting out. Look at this chart. You guys will definitely see a clear correlation between reinvesting your dividends and not reinvesting your dividends. Reinvesting your dividends, what you do is all the money you get, you buy more shares, and then those shares get you more dividends, and then you buy more shares. So you start this compound interest where starting out maybe you only make $1 a year, but then the next year you may make $3, and then the following year you may make $12, and then over the course of 40, 50 years, however long you guys invest, this will add up to thousands of dollars in just passive income that will automatically get pumped back into these companies, and then they will pay you more money and more money and more money. It's just a great way to invest with very, very little downside, and you're not like pulling money out of your pocket. This is all money, and you guys can just literally click a button that says DRIP activate, and you guys will be good. And on all the brokers we covered, they all offer DRIP, which is great. All right, so now that we have a general understanding with investing in stocks and ETFs and some good, brokers and account types, Carter, what is your investment strategy? Because just because you have an account does not mean you're gonna make money. Just because you invest in the stock market does not mean you're gonna make money. So the first thing you have to understand is, what is your goal? Setting a goal is very, very important. If you're looking to make $1,000 a week and you only have $1,000 to invest, honestly, leave the video. This is not a get-rich-quick scheme. If you're looking to make $200 a day, it's definitely doable, but you just have to have the account size that meets those needs. So for me, I felt like the best strategy for a long-term investment is actually really, really simple. So the first thing I do is I visualize a pie. For me, this just makes it a lot easier because I can understand where to invest different money. So right off the get, I invest 60% of my money into something called the S&P 500. Now, I use VU or SPY. These are just ETF tickers. Both are, honestly, they're the exact same, so don't be overwhelmed by those. But investing 60% gives me a good chunk of money that is automatically invested, and I don't have to worry about it. The S&P 500 represents the top 500 companies in the United States. The beauty of this is you don't have to actively buy, sell, or even watch what's going on. It's like investing into the US economy. If you guys think we're gonna grow as a country, I would just recommend investing in this and you guys will be set. But the beauty of this is you guys get different bits and pieces from different companies like Apple, Google, Tesla, and all these other fantastic ones. This is a great way to invest with very little downside, just because over the past 90 years, it's had an average annual return rate of about 10%. So it's a great way to get appreciation, plus it offers a dividend, and it's just a very, very low risk, high reward play for the long run. And like I mentioned, I invest 60% of my money into that. Now you may be saying, Carter, what do you do with the other 40%? Don't worry, I got you. But before we jump into that, hit that like button and subscribe if you guys are getting anything out of this video, because it really helps me out. All right, so what I do is I take another 20% and I invest into blue chip companies. Blue chip companies are just well-established companies. It's companies that I'm sure you and I use every single day. It's companies like Apple and a variety of other fantastic ones, Johnson & Johnson, Home Depot, all very, very well-established companies. The beauty of investing into blue chip is often you will have a little more dividends and a little less growth, which is completely fine because I want to build up that passive income, and I'm looking at growth later when we talk about my growth stocks. But like I mentioned, I do invest about 20% of my money into blue chip. So I invest 80% of my money so far, and the other 20% is actually really simple. So pretty much what I do is I take another 10% and I invest into high growth stocks. High growth stocks are companies that definitely carry a ton of long-term potential, but are gonna be very, 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 very volatile. They're gonna go up and down, rapid rates. These are companies maybe like Palantir, maybe like Neo, companies that are definitely not well established, but definitely have a ton of long-term potential. Right now, I've been very, very tech heavy, investing in a lot of AI startups and companies like that. And if you guys want me to do a full separate video breaking down all the companies I have, hit that like button and comment if you guys want me to do it or not. But like I mentioned, I invest 10% into high growth stocks. This is because I want to have a little bit of some growth. I want stocks that are moving, stocks that carry potential. Now, if I'm even right on one of these things and I invest $1,000 into it, it could be a company that becomes a $20,000 or even $30,000 off $1,000, which is great. So what I do now is I take 5% and I leave it in cash. This is because if I see any stocks that are undervalued, I want to make sure I have cash available to buy. If something sells off a lot, I want to make sure I buy. Also, if the general market, if we go into market recession, I want to make sure I have cash available to buy those dips. It's just a great way to always make sure you guys have some sort of stability in your account. I would highly recommend having cash. And then the last 5% is my fund money. This is companies that definitely could lose a lot, or companies that could make me millions. It's a lot more higher risk than the, just the straight growth. Higher risk, high reward. These are companies, honestly, that are make or break it, or companies that could be definitely the next Facebook, but they also could go into the dirt. They're highly risky, and it's just fun money for me to do and invest. And trust me, I invest a lot of money, so I feel like this gives me a little grounded, because if I just only invest in the S&P 500, honestly, I just get discouraged with myself just because it's so basic. But I would highly recommend, if you guys are just confused, the best strategy for most people is just to invest in the S&P 500 for 40 years. If you invest 10% of your income, for 40 years, you're gonna be set for life, guys. So hope you guys enjoyed it. If you guys have any questions, let me know down in the comments. But this is my investment strategy for 2023. I hope you guys enjoyed it, and we'll see you guys later. Take care, guys.